Thank you very much, Wolfgang. As you mentioned, banks and financial institutions in general have been key trusted partners along with the government since really the beginning of fractional reserve banking. And as we look at the long list of new technologies and digital transformation that we need to bring to the sector in order for it to be efficient, effective, and serve a much broader sector of our society, public-private partnerships are a key way to achieve that. And so we've assembled a panel today that hopefully has a view across the whole ecosystem. We really wanted a diversity of perspectives and folks who are working on these issues from a number of different areas. So Yasmine, maybe if we could start off with you and just have everyone introduce sort of what their role in the ecosystem is and how their institution is engaging in partnerships.
Thank you, Conan. A very good evening to everyone. I'm very pleased to be here today and to be part of this panel. My name is Yasmine Al-Sharaf. I'm heading the Fintech and Innovation Unit at the Central Bank of Bahrain. For those of you that don't really know about the role of the Central Bank of Bahrain, basically the Central Bank of Bahrain is the single regulator of the Kingdom of Bahrain. We are in charge of maintaining financial stability as well as the monetary policy for the kingdom, and we also engage in writing regulations and policies for the financial services sector. The Fintech and Innovation Unit was established back in 2017 in response to the emergence in technology and the way that technology is really affecting the financial services sector. So this unit is mandated with ensuring that our financial services sector remains efficient, that we are agile to foster fintech and foster the innovations, and to come up with the regulations that would support such innovations without risking the stability of the financial sector, and whilst having mitigants in place to ensure investor protection as well.
Great. And Peyman, maybe a view of how DIFC is engaging in partnerships.
Just testing. Test. There we go. Makes me feel like Britney Spears. She made it cool. I have to say there's a few things to note before talking about the DIFC. I have to talk about the D in DIFC, which is Dubai. Historically, after the move from the pearl industry into oil and the growth. And what's happened in Dubai in terms of, when you look at the 70s, the growth of trade happening in Dubai, 80s and 90s, we probably moved into tourism a lot in Dubai. And then in the 2000s, the diversification play was, financial services. So in terms of the decades and what was important, and really the play with financial services, given the fact that Dubai as a city or the UAE as a country is fairly small and the capital markets are not very large, the play was always a platform for the greater region, and we always talk about the Miasa region and Dubai being the hub or the place to engage with the rest of the region. So. It was, a play that we always looked at and said, we need to enable and we need to help enable. And that word is quite strong, along with the word innovation in Dubai. That's what the DIFC does. It is hopefully, to some degree right now, given our position as an international financial center, an enabler for partners with trade across the Miasa region, including the African continent. And
Perfect. And Larry, you're here from the Center for Financial Inclusion, which has been a partner with the IF on a lot of our research on financial inclusion.
Great partnership.
So maybe a little bit about what CFI does and the position in the ecosystem and what informs your perspective.
Right. The Center for Financial Inclusion is an action-oriented think tank. And our role is to challenge and engage the financial services industry to protect and empower the client. So we take a client-based perspective, client-centric perspective in looking at financial inclusion and how we make sure that services are brought to clients. In that, for us, financial inclusion is not someone having a bank account. Financial inclusion is someone having access to the financial services they need and the knowledge and power to be able to use those effectively. And my research lately has been on positive deviance. I'm looking for banks that partner with governments in delivering social payments, but see that as a profitable customer base that they want to grow. So rather than just being a post office box where people take out their money as soon as it comes in, I'm looking to find banks that actually work with this customer base and broaden the services that they provide to it.
Excellent. And one of the things that's been important in that partnership as well is that we've really looked at mainstream financial inclusion, which means a sustainable business model. And one of the things that we say is if financial inclusion is done right, it's not just the right thing to do, it's also good for the bottom line.
Right.
And that's been a key point of our research together. And then, Christos, from Moody's, you have sort of a view across the industry and what a lot of the strategic imperatives are for an industry that's transforming for a digital marketplace. So some comments.
Yeah, and like Larry, that you advise and you challenge, we monitor, we observe, provide our opinion through our credit rating, through our research. And indeed, I think our role to play is the fact that we have this institutional knowledge, viewing markets globally, knowing what happens in different systems in the world to provide our opinion about how some of these lessons are applicable in the markets that we monitor in. So for example, I monitor banks and financial institutions in a number of countries in the region, and we're generally asked to opine about developments in the regulatory environment, in the partnerships between the private and the public sector, in developments in the digital technologies, how these impacts the banks, the banking system. And definitely we've seen that these trends could reshape franchises, could transform the competitive environment and the economy. And generally we've seen that with financial inclusion, the benefits for banks are much greater, even though that we're seeing a lot more competition these days from other lean and agile players. We've seen that the benefits are much greater for banks.
So Yasmine, I think you had a few more comments as well about the approach that you're taking to partnerships in the marketplace. Yeah.
To answer that question, Conan, I just wanted to give a brief history of Bahrain's position as a leading financial center. You know, Bahrain has a long track record as being or having a business-friendly kind of environment. We are home to the Gulf's oldest and largest financial services sector and the most diversified economy, with the financial sector being the largest non-oil sector contributing to GDP, contributing around 80% to GDP. And we realize at a government level that that level of success takes a unified approach to collaboration and partnership on both government to the private sector level and within the private sector as well, between banks and startups and fintech companies as well. Over the past couple of years, when this whole movement, towards digitization really started to pick up, we realized at the government that it is now more than ever important for us to collaborate and engage in partnerships to ensure the efficiency of our financial services sector. And we have created what is known today as the Team Bahrain approach, which is endorsed by His Royal Highness the Crown Prince. Team Bahrain is really about having the government collaborate with the private sector to come up with agile solutions for entrepreneurs, innovators, as well as for existing financial institutions. At a regulatory level, we also focus a lot on collaborations and partnerships. It's at the very top of our agenda. And with technology today, what essentially is happening, first of all, it's technology is creating the borders between jurisdictions to kind of fade out. Companies are starting to operate cross-border. So it is extremely important that regulators collaborate together and partner up to create more harmonized regulations to avoid any regulatory arbitrage that may occur from operations happening cross-border. We are very, very active in the scene. We are a member of the GCC Fintech Working Group, and that includes all the GCC financial regulators. We're a member of the Arab Monetary Fund Fintech Working Group, and we're a member of the GFIN network as well. We also have some bilateral and MOU agreements with several other financial regulators. We also encourage a lot of partnership and collaboration within the private sector between banks and fintech companies and other telecoms or big tech companies. And in the Kingdom of Bahrain, it's actually been the regulator who's been very proactive and pushing for the innovation rather than the private sector. As a result, I can give you a few examples of such partnerships that have turned out to be very successful. We have, for example, the 4 national wallets that have been regulated in the Kingdom of Bahrain, and they are a direct result of partnerships between banks and telecoms and other tech companies. And through these e-wallets, they really support financial inclusion. From another end, we also rolled out the wage protection scheme at a national level, and we've partnering up with telecom companies, with the banks and with other companies in the kingdom to make this a reality. We're currently in the initial phase of implementing the wage protection scheme. So what essentially the wage protection scheme does is we are mandating all employers within the Kingdom of Bahrain to transfer salaries through wire transfers either to a bank account or to electronic wallets within the Kingdom of Bahrain. And by that, we will then have financial inclusion, tapping the blue-collar workers, which we have a huge, let's say, percentage of in Bahrain.
And that introduces a few key topics that we'd like to get back to a little bit later of G2B payment partnerships as a primer for the pump. But as we get ready to go to you, Peyman, with a question to lead us off in a dialogue about the different types of partnerships. You've provided several examples just now, but really give a flavor of the different shapes that they're taking, the different models, how different models are appropriate for different objectives. So what are some of the transformative developments that you see, some of the efficiencies that are coming into market, and some of the different partnership models that you might need in different areas? So start us off with an open question about the different examples and the different models that you see for partnership.
Well, I think for partnerships to take place, you need the ecosystem to be there, and we're fortunate that at the DIFC, we've got an ecosystem that comprises 17 of the top 20 global banks, 5 of the top 10 global insurance companies, the big 4 consultancies, some of the big law firms out of the region and in the world based over there. And that allows for this partnership to happen. The one that is a great example, which I'd love to share, is a Swedish-based fintech company called Norblock, which actually came into the DIFC in the first cohort of our fintech hive, our accelerator, and has graduated since then. And the project is a KYC project on the blockchain, and it has resulted in a partnership, a 3-way partnership between the DIFC, Norblock, as well as Mashriq Bank, which it's being tested on at the DIFC. And the objective is to have this up and ready in Q1 of 2020, and then expand out of the UAE into the region, but also into the greater region, the Miasa region, and specifically the 3 billion population, 70% of which is unbanked. This is going to be something that will tremendously help people become banked. So great example of that.
And I want to come back in a minute to some of the digital identity issues that raises. But as a starting point, are there some key takeaways that you've learned from that partnership that really worked well and that you'll seek to replicate in other partnerships? What were some of the things that made it successful?
I think the biggest thing for us is the fact that a European fintech decided to come and make Dubai its home. It's definitely helped. There's a tremendous amount of work. I mean, I could tell you the working group at some point in time was 20 people working on this tripartite agreement and then going into the actual development and all that. So being on the ground, I think, is quite important. That's been a big learning, and I think a lot of people look at that as something that they want to do and are more willing to do. The other thing is, once again, the ecosystem tremendously helps. It's all on the ground in one jurisdiction in a series of buildings. That's been tremendously helpful. It also helps, obviously, that the DIFC not only can connect to partner banks, whether they're international banks or local banks, whom we have relationships with as well, but also continues to work on its regulation, and I think all of us do in the region, but also has the ability to fund projects like that. I think that's definitely a draw for people. So the DIFC has a $100 million fintech fund, which we're very soon about to announce our first investments in. So that's definitely a draw. So I think all of that is what I would say are big learnings for us, and we're seeing a lot more interest after the announcement of Norblock externally.
Maybe, Yasmine, I don't know if you have any more comments to bring in, but those examples of partnerships that you had run through before, as you reflect on some of them, what were some of the things that made the successful ones successful? And another element is it doesn't necessarily have to be a direct partnership between a government and another entity, that because the supervisor and regulator really set the environment for innovation and change and digital transformation of our sector, sort of blessing a bank fintech partnership or creating the space and the environment for those types of partnerships to bloom can be an indirect way, I think, for governments to really partner in the full ecosystem.
Absolutely. Conan, I just wanted to give you another example of a really good partnership model that occurred in Bahrain, and that is through open banking. We have issued our open banking regulations back in December 2018. And essentially what we did is we followed the UK's model in mandating all our retail banks. I know in the UK they've just mandated the big 9, but we've decided to mandate all our retail banks to fully partner and collaborate with licensed third-party providers to share consumer and customer financial data, of course subject to customers' strong consent and authentication and all that. And it has been really successful so far. Our banks are now all ready. They have all implemented the required infrastructures. They've got the production APIs, and they're ready to go live by the end of this year. And I think that is a great example for such collaborations. Open banking focuses on customer centricity. It puts the customer at the very core and heart of the financial services. It provides transparency, allows consumers to shop around for the best offers out there without being confined to a single bank. And it really enhances financial literacy, I think.
And one of the keys, for us when we look at open banking regimes is getting the data permissioning right, and that's frequently having it be customer-centric, customer permissioned, so that data can flow. One of the some of the early open banking initiatives really focused on breaking open that banking data into other sectors to try and move the fintech development. But as we see major platform companies like Alibaba, Tencent, Google, Amazon, and others able to move in at scale with billions of customers around the world, making sure that it's a different framework where data can really flow once it's permissioned by the customer across sectors and across even jurisdictions freely is, I think, an important principle that we'd like to pursue. And clearly one where there's a very strong public-private partnership objectives to getting that.
And Conan, they say that data is the new oil, and we are moving towards a data-driven economy. Yeah. And I think open banking is the first step. What essentially is going to happen is we're going to start seeing the banking sector partnering or collaborating with other sectors. So it's going to be a fully open economy. And we're going to move from having a local open banking to cross-border open banking as well.
And my little, it's a small tick that I have, but data is somewhat like the new oil, but it's actually more like a very unique asset because it doesn't get exhausted the way oil can get exhausted. The same data element can be used by many people across the economy. So we're starting to also think about the economics of data and how it's very different from a lot of other resources that have existed before in the economy because, again, it can be used by many without being exhausted.
Data, you could refer to it as the weapon of mass collaboration. That's the way we look at it.
Or mass destruction. You can choose.
Why we have to get the framework right. So we were mentioning sort of a customer-centric focus there a bit. And Larry, I know that's been an area that you've really dug into. And a lot of the sessions this morning have been sort of an implied focus on how do we serve the unbanked and the poor and customer segments that have been more difficult to serve, because when we use these new technologies to make things efficient and effective, we'll get there. But you've looked a little more directly at how partnerships between banks and the government to serve government payments can really be an important piece of the pie. So can you share a little bit about those partnerships and what works well there and what some of the pitfalls might be?
And the reason I wanted to look into this is when you look at the Findex data, the primary group of excluded people in the financial services is women living in extreme poverty. And who government social payments primarily go to are women living in extreme poverty. So this is the best chance to get the most people in the quickest into financial inclusion. But the way it's traditionally done is the government sets up accounts in state-owned banks. The money goes into those accounts, and on the day it comes in, there are long lines at the bank or the ATMs, and everyone takes out all their money. So it basically is setting up a a more efficient post office for the money. And it's not real financial inclusion. So I wanted to look at where they had created customer choice in these systems, where customers could choose who they were going to establish their account with, and then it would foster competition between financial service providers so that the customer would choose whoever was closest to them or whoever provided the best service. And so I've looked in 4 different countries, Dominican Republic, Paraguay, Kenya, and Zambia, who all have different approaches to doing this. The key elements of success, first is a mindset on the part of both the banks and the government, which is not, the traditional mindset is, these are poor people, they need money from the government to survive. So let's get the money out to them as efficiently as possible. The new mindset is, these are people with industry, with creativity, who have lots of financial transactions, and who have the ability, they already have their own livelihoods, which could expand, and they could create businesses as well. So in this context then, the systems that work, first of all, in designing the bid structure, there's always someone from a bank that serves on the government task force or that works with a consultant that's putting things together so that that knowledge is there combined. The other thing is the banks have to look at this as a transaction-based income stream. They get a certain percentage every time someone uses their account. And so they establish an income stream out of this. Then the successful banks that make profits out of this, they look at the whole value stream associated with the person receiving the payment. So they sign up the merchants that those people buy from as their agents. And then they provide loans to those merchants because when the money comes through, people are going to be buying lots of things. So they need to stock up for those times. The banks that do this see this as a way, some see it as a way of building a national footprint, that they may be regional. This way they can build a national footprint, and they have customers that they start with that they can build on and build a wider customer base, starting with these government accounts. Others see it as a way of, they already have a footprint in different places, and these are ways that they can expand the number of customers they have in their existing footprint. But I think interesting to me was most of the banks involved in doing this well, their attitude was, we grow as our country grows. We see this as an important way of not only alleviating poverty, but actually building, especially in the rural areas, building a stronger economy in the rural areas. And as we do that helps the number of transactions, the number of investments, the amount of savings. So this is a way that we not only build our bank, but we also build our country. We all benefit together.
And again, a key takeaway, I think, is equal partners from the beginning, from the design phase.
Right.
Make sure that the systems are designed correctly so that it's a sustainable, growable business
Right.
with, as you said, a revenue stream rather than
And fostering
social
competition
service.
that, it's not an exclusive area for any bank, but they have to compete with each other to get those accounts.
So Christos, I wanted to bring you in a little bit as you at Moody's look across the sector and what's important to make a more efficient, effective, inclusive industry. What are some of the examples of partnerships that you've seen that help drive those objectives for the industry?
Yeah. In general, as discussed in the previous panel, I think banks, technology companies, mobile network operators realize that nobody can do this alone. They need to cooperate. And as I said, the benefits of these are far greater than the competition. So we are seeing more collaboration in this space. And effectively, banks and other players in the market view collaboration as a way to fend off further competition. I'll take a market, I'll throw you to Kenya, taking a market like Kenya. Even though M-Pesa has such a dominance in mobile payments, it stole from the bank's payment-related revenue. Today, the banks are better off because of this. They're better off because the bankable population has expanded. They have a larger pie to target in terms of their product services. Also, the cash flow flowing to the financial system is much greater than what it was previous to M-Pesa. So now what banks are doing are leveraging on the network, the customer base of M-Pesa, trying to sell higher value-added loans and services on that. So M-Pesa formed an entry level of customers into the financial system, and now the banks are trying to expand the financial services available for these people. So in cooperation with M-Pesa, using the data of M-Pesa, they are cooperating, they are giving loans, and today the volume of loans given by mobile phones in Kenya are actually larger as a percentage than the volume given out of branches. So you've seen that cooperation. And also the banks are emulating the network of M-Pesa, their own mobile networks, their own agents in order to lower the cost. And generally, despite the challenges that we have seen in Kenya with the interest rate caps that were recently removed, by the way, the challenges in the operating environment, the payment-related revenue that was lost, the banks remain very profitable with high growth prospects and healthier than what they were previous to M-Pesa, because now they're more diversified in the rural areas. So we're seeing that cooperation playing out there, even though M-Pesa was a formidable competitor for the banks. In other markets, we're seeing similar trends where the challenges have taken a lot in the payment space, but the core banking services of the banks, lending, deposits, are still dominated by the banks. Yet again, we're seeing banks investing heavily in their own technology, cooperating with Fintech, as the previous panel discussed, forming strategic partnerships with Fintechs, investing through incubator centers, accelerators, startup funds with Fintechs. And we discussed Citi's involvement in Mexico previously, and Mexico is actually the largest fintech market in Latin America, and we're seeing a collaborating environment there where the largest amount of fintechs are operating in the lending space, primarily targeting the unbanked. And the reason Mexico is the largest fintech space is because banks are actually funding them, partnering with them, and supporting them in this endeavor.
Great. And Larry, I think you had some response to some of those points.
Well, just in looking at how the government of Kenya chose to distribute its social payments and this decision around M-Pesa, the government did not want to be dependent on one major provider. So it set up its bid in such a way that M-Pesa was not a bidder. It required fingerprint readers because a lot of these payments go to the elderly, and PIN codes wouldn't work for the elderly. And it set it up so that banks were the ones that it was open to, but that way they got two state-owned banks, two private banks involved, and they fostered more competition even with M-Pesa because they sought other providers that could serve these customers.
Yasmine, any points on?
I just wanted to add to that. I mean, collaboration and partnership, we may find that banks at the beginning, they might be a little bit resistant because they might think that it's purely competition and that those fintechs or those new tech companies are taking their share of the pie. But in reality, it's really a win-win for all, partnerships and collaborations. And I always see this, like banks, they're really the big boys. They've got the capital, the funds, and they really own the customers. But what's happening is they're really burdened with legacy infrastructure, and they're being forced by fintechs to innovate and to meet the new expectations of the millennials. So by collaborating and partnering up with the fintechs who are investing in really advanced technology like new infrastructure, they can really build synergies, and it's going to be a win-win for all. They can really retain customer loyalty, they can provide more innovative solutions. So I don't think it's really a competition. I think it's really, it will enable the banks to actually build more efficient solutions eventually.
And whether it's partnering with fintechs or using, for instance, cloud service providers to help with their digital transformation of the core, Christos.
And also, a very interesting example in Mexico again, it's not just fintechs, financial services companies that cooperate there. We've seen an example where financial services companies provided a very low, cheap point of service platform to accept cards and digital payments. And they actually used a bakery that provides services to its products to all these small merchants across the country, and they use the sales force of that bakery to sell that low-cost payment service to all these small merchants in order to take them into the digital ecosystem, which is another example of not just the financial services cooperating between them, but other companies coming into that mix as well.
I saw an interesting partnership in Paraguay where it's Tigo is the MNO there, and the dominant one, and it has Tigo Money, and they work out in the rural areas to distribute these government payments, very remote areas that they work in, far up the Amazon River, and the government allows only so much money on the phone wallet. So Tigo negotiated a back-end deal with a couple of banks so that any time the money got above that amount, it automatically got deposited into a bank account. And then they had a lending system set up as well, because Tigo had all this information on the transactions and how much money they held in their wallet and the merchants they went to, all of that. And so they set up a credit scoring system based on that the banks honored. And so they were able, through the merchants, to do the KYC and deliver loans way up the Amazon River, where in some places it's very difficult to get cash up there. So there's cash is scarce. So sometimes the boat will come up the river and they'll have a market day at a certain point, and people will either barter animals and food, or they'll use their mobile phones as their wallets. There's no cash involved. It's the two other extremes of the financial industry.
So I think we've had a really good spectrum of the different partnership models that exist in the marketplace, some of what they're addressing, some of the challenges that they have. As we have a little bit of time left on the clock, I wanted to talk about one of the great buzzwords of this area, and that is sandboxes. But what we, at the IF, we like to look beyond sandboxes and really talk about how do the public sector and industry work together to move the industry to these new technology models, these new business models, new channel partners, new partnerships. And sandboxes have been one way that everybody is employing. So maybe some comments on sort of what's working well, why sandboxes, and as we look beyond either next generation sandboxes or what's beyond them, how do governments and the public sector and the private sector work together to move to these new technologies of distributed ledger, cloud computing, quantum computing in the future, digital identity solutions. So maybe, Yasmine, if you could start us off with a few more comments about the GFIN and some other sandboxes.
Sure. I mean, the regulatory sandbox is a great example of collaboration between the regulators and innovators, as well as existing financial institutions, the incumbents. So what the sandbox essentially does, it's a regulatory mechanism that enables startups, as well as existing financial institutions, to test out their innovative financial solutions in a controlled environment, which is within a limited time period, directly with volunteer customers, subject to extremely light regulations, so they don't have to really comply with the full regulations in case of being fully licensed by the central bank. And the sandbox really provides a lot of advantages for these startups and innovators. First of all, it enables them to test out their solutions and develop them, to use the period within the time period during the regulatory sandbox testing period to develop the infrastructure, the technical solution, to test it out directly with volunteer customers, to test the viability of the products or solutions, to check for the market demand, and to get more familiar with the regulatory environments, the regulations in place. And it also works to help the regulators to, first of all, have an open line of communication with these innovators, to understand more about the innovations, to enable the regulators to make the necessary reforms within the regulations to foster these solutions upon graduation.
And now the Global Financial Innovation Network has brought that model sort of global, and you're involved in the GFIN, as we call it.
Absolutely. So the GFIN, the Global Financial Innovation Network, it was formally launched back in January 2019. And it built upon the FCA's original idea of having a global sandbox. So the GFIN really brings together financial regulators and other financial institutions interested in innovation. First of all, to tackle policy challenges when it comes to financial innovation, to try and share experiences and learnings, And also where a major portion of our work is to focus on enabling cross-border regulatory sandbox testing. And we have launched the first cohort for the GFIN cross-border regulatory sandbox testing, but it didn't kick off very well for a number of reasons. And I think we have a number of challenges, the most important of which is that different jurisdictions around the world have different sandbox requirements, different licensing requirements, different standards and eligibility criteria when it comes to entering the sandbox. So that was one of the challenges that we faced. The second challenge is a lot of the fintech companies or these startups require a set of dummy data to use for testing their solutions, and there was a lack of that data. So what we're essentially doing now at the GFIN is we're trying to come up with a regulatory kind of compendium to combine all our regulatory sandbox requirements to try and harmonize them, standardize them, and we're going to start kicking off the second cohort for the global sandbox testing.
Excellent. And the IF, it's exciting that I think the GFIN has been very honest about what's working, what's not working. Two, we're always interested in things that are working to harmonize the environment for global finance across borders and across sectors, and I think that's been an important focus. There's also been an explicit focus on RegTech, so solutions that make compliance more efficient and more effective, another thing that we're excited to see in the GFIN. So we hope that, notice a number of new jurisdictions have joined just in the past couple of weeks.
Yes.
So we hope that we can build on the good there and keep learning from the things that don't work as well.
At least everybody's talking. I think
yes.
that's the key point in GFIN. So.
And brought up, I don't know if anybody else has any comments, but I think identifying the fact that data environments are really needed. Financial crime solutions is another area that the IF is very focused on. We currently don't have, the solutions are too expensive. We're not seeing the success rates that we'd like to see, and the industry and public sector really need to work together to do much better in that area. And feedback loops and data sets is a critical issue there. In the area of fraud, where you have reference data sets and feedback loops that hopefully the next speakers will be addressing a little more directly, we see success rates over 80% in preventing card fraud, for instance. But because you don't have the same feedback loops or data sets in money laundering, we're seeing performance rates of 1% to 2% of financial crime being blocked at great expense, which is not something that I think we're comfortable with. Any other thoughts on problems like that, where, for instance, whether it be data sets or a regulatory signal that it's okay to try something, or a regulatory engagement that you think a sandbox or some other mechanism might be the right way to move the industry?
I think for us, the one thought that comes to mind is the area of remittances, which, if you take the entire region and the amount of remittances that go out to the top 5 countries in the world, I mean, it's a tremendous number. And a majority of that is still going through all the exchanges and things like that. So it's an area we feel that is definitely there when it comes to some sort of fintech technology and disruption, I should say as well.
Well, I would just say,
last word.
On a regulatory basis, the thing that makes the biggest difference for financial inclusion for people living in poverty is to make sure that agent banking goes along with digital banking, because people who aren't used to the technology, they need to transact with someone that they've transacted with all their lives, and they can learn it that way. But if you have the digital without the agent banking, there's not going to be much adoption.
So thank you very much for listening to our session. I hope that gave you a flavor of all of the long to-do list items for cooperation between our industry and the public sector as we work together to move to a new technology stack for the future. So thank you very much for your time this afternoon.